Auzu billahi minash shaitanir rajim. Bismillahir Rahmanir Rahim. Welcome to all the participants, our esteemed speakers for the weekly Islamic finance webinar organized by TAMWIL Academy in association with TAMWIL FinServe LLP. Without further delay, I would now request our esteemed speaker, Professor Dr. Shahul Hameed, who is joining us from Malaysia, to take us forward on the topic of Islamic capital markets. Jazakallah khair. Professor, please.
Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah rabbil alamin bihi nasta'in wa salatu wassalamu ala ashrafil anbiya wal mursalin sayyidina Muhammad wa ala alihi wa sahbihi wasallam. Okay, today we are just going to introduce the Islamic capital markets for you. And basically Islamic capital markets have many sub-components, okay? They include the equity market, which is the share market, and the sukuk market, which is the Islamic alternative to bonds. And we have other markets like money markets, foreign exchange markets, and also the what you call derivative markets. These things are quite complicated, and inshallah, and we will discuss them in future seminars. But today we are going to specifically note the major components, and then we are going to look at the equities market in a bit of detail. So basically, the real sector of the economy produces the nation's goods and services, and the financial sector plays the vital role of providing the financing needed to fund this productive activity. So basically, you have to do this by mobilizing the savings of surplus units and channeling them to productive units that need the funds. So surplus units, what do you mean by surplus units? They can be households, individuals, corporate companies, government, foreign investor. The surplus units mean those who have a lot of money to invest. And the deficit units are those, again, they can be other individuals, other corporates, other government who need the funds, okay? And then there are two ways going through getting this thing and joining this, linking these two surplus and units, deficit units together. And that is through the banking system, which is going through this, and then through the capital markets and direct financing, okay? So capital markets, it gives you a much more wider and broader and more access to a bigger amount of funds in the banking system. Okay, so for corporates especially and businesses. So the key components of a capital market are the equity, as I said just now, and the debt market, which consists of money market and bond market, and the Islamic alternative is the sukuk market here. And we have a foreign exchange and derivatives, which are more complicated. We'll come to that later. So what do capital markets do? They provide efficiency, okay? So capital market, if it's efficient, then it will allocate the resources of the economy efficiently, okay? The market determines prices, provided there is no hanky-panky and manipulation in the markets, it will provide the price signals for proper allocation. So where capital markets are hindered by manipulation or whatever, then there will be a misallocation of resources. And that's why we have a capital market regulation, so that we will minimize these hindrances, okay, in the misallocation. And retarded capital markets lead to retarded national competitiveness, and also it will lead to dangers in the real sector, that is the productive sector. So capital markets, there's a lot of recent financial crises. There have always been financial crises, but now it seems to be more frequent, and the depth of the financial is even worse. Okay, now the last time only developing countries have this financial crisis, but now it affects all countries. And sometimes if you have a financial crisis in the stock market or capital markets, you lose a lot of hard work and capital accumulation over a long time. In a matter of weeks, everything will be gone. So this is very dangerous and very risky. And that's what happened in 2008, okay? And so the resulting pain, it will cause misery not only to the capital market, but to the whole economy as well. So people who are, have invested in pension, in the pension funds, insurance companies all suffer. This will lead directly to the human suffering of poor people who have, there's no other cause, they've invested and they lose their investment. Okay. All right. And the most of the financial crisis, okay, the last 100 years, The single root cause is excessive leverage, which is most debt. And this, we are talking about interest-based debt. Maybe this is why Allah made it haram for us. Okay, so you can see that from 1970 to 2020, the world debt is going up and up as a percentage of the gross domestic product, So this is not a very good sign. Okay, so this is the cycle which affects. If the stock market is down, market volatility will go up, collapse of institution, even banks, credit markets, you cannot get loan to fund your businesses. Commodity price also will collapse, and and that will lead to very big problems in the real sector. So transmission to real sector, financial sector crisis lead to real sector deterioration, mostly to credit freeze. That means you won't be able to get loans from banks and all that. And nowadays, the depth of recession, how long it lasts and how deep it is unheard of levels like before. And this is mainly due to manipulation and cheating actually in this thing, not because of anything else. And also the use of improper derivative instruments. Okay, so trends in the capital market. Now, financial technology, fintech appears to be shaking the world of finance. Okay, it started in banking, but now it is spread to capital market. Okay, for example, it reduces the cost. Fintech reduces the cost, and it makes it faster. For example, you can actually, if you want to start something, maybe build a masjid, you can go and use crowdfunding to pull the money in if you want. Okay, or something like that, and so equity. Hold on. And so actually you would see that, now if you have UPI and all that, that is fintech working in this thing. You don't have to go to the bank, you use your mobile phone, that is fintech. Okay. And then inshallah, now the payment system of now the Western companies are, forcing us by sanctions and all that. They want to exclude us from this, what you call SWIFT system and all that. So the alternative system, like India has UPI, we have a Chinese financial system, we have the Malaysian financial system, we have the Russian financial system, alternative to SWIFT. Now the BRICS will probably combine all this alternative to the Western one, and we can be free of the financial sanctions. So let's look at equity markets. Basically, equity markets is essentially risk-sharing financing. That means now this one, in the debt financing, you transfer the risk from the lender to the borrower. But here, equity market, you share the risk. Both of the investor and the investee will share the risk. Okay, and there's no fixity of returns. You cannot get a debt. Okay, 10% or 8% fixed, you cannot get it in the equity market. It will depend on the profit. The returns to equity are linked directly to the returns of the underlying business. That's why it is halal, okay. So if the business does well, you will do well. You will get more dividends. If the business doesn't do well, you will not do well, okay. So equity is congruent to Sharia requirements for risk sharing. There is need to avoid companies which undertake haram activities. This is the only point in difference between the Islamic equity market and the conventional equity market, that we need to avoid companies who undertake haram activities and are financed by riba-based loans. Okay, these are the two things. So how is this done? It is done by something called Sharia stock screening. So before they invest, you have to see what type of business they are in and what is the mixed business. How much is the haram level of debt and haram level of haram earnings and so on. Let's look at this. Okay. So we'll look at the debt market later. Okay, and the money market. So we'll go to financing. So we already seen that there's no fixity of returns and so on. So I'm not going to repeat this. Okay. So basically, equity financing very much profit and loss sharing with all the business is thrown in. Okay. So basically, there are different type of stock and share. Mostly the common stocks and share are completely halal. But if it is a underlying business is halal, then they are halal. But sometimes the preference share and cumulative preference share, they might not be halal. So they might be, we have to have a closer look at it. Okay, but mostly nowadays they are common stocks, so it's okay. So since stocks are basic agreement, Sharia compliant stock would be the basic component. How okay? Besides Sharia compliant stocks, Islamic capital market has led to other Islamic products like Islamic real estate investment trust, where a company is formed and they invest in real estate, and the rentals from the real estate is channeled back to the investors. And then mutual fund is a unit trust where there's a portfolio of shares, Islamic Sharia compliant shares, and then they give the dividend to the investors. Okay, so Islamic and non-banking financial institutions are companies like pension funds, investment bank, takaful company, cooperative. All these institutions can share in the Islamic capital market. Okay, so how do you screen for stock compliance? Okay, Malaysia was the first Muslim country with a conventional stock market to come out with the formal evaluation of Sharia compliant stocks and a Sharia stock index. And then in 1999, the Dow Jones published the Wall Street Journal and financial information provider Dow Jones Islamic World Market Index. They came up with this Islamic index. Okay, this is a global index of Sharia compliant stocks. In determining whether a stock is a Sharia compliant, a screening procedure by Dow Jones is used. Okay, which is quite different from the Malaysian screening. Okay, let's look at the Malaysian screening first. So the screening is done not by individuals or consultancy companies, but a Sharia Advisory Council, which is resting under the Securities Commission. Now the central bank has its own Sharia Advisory Council, and the capital market, the Securities Commission, has its own Sharia Advisory Council. And these are the people who do the screening. And they do this every 6 months to see whether they are still Sharia compliant or not. So those who are no more Sharia compliant will be dropped, and new companies which are Sharia compliant will be added every 6 months. Okay. So in order to screen, what they do is finally, they will do two things. There are two screening process. One, they look at the line of business or core business of the underlying company, and how is the company financed or capitalized. Okay. So here, so in the line of business, a company can be completely haram. Like if it is manufacturing alcohol, it's completely haram. If it is in the conventional bank, it is completely haram. If it is gambling, it's completely haram. Then the more usual case is the mixed one where there is haram and halal. Okay. Normally, from a strict Sharia point of view, a mixed business cannot be Sharia compliant. But unfortunately, the world is not like that. So we have to do some distinct to the Sharia. In Sharia, there are some qawaid al-fiqhiyah, the fiqh rules, which allow certain things in certain when there is a necessity. Okay, so there is the Sharia this thing. So that's why the Sharia scholars allow this, but they have to go and do the criteria and how much is halal and how much is haram. And they have completely halal companies, okay, which is rare because even if the line of business is halal, the funding might be haram. They might borrow a lot of money to fund the activities. So that becomes a problem, okay. And then beside the line of business, we have companies' finances, and this is, okay, how much interest income is earned and how much interest is paid and how much is the total company capital is made up of interest-bearing debt. So these are two type of screening we have to do. Okay, so the first phase is a thing which is completely haram is ineligible for further screening. So okay, so those which operations involve gambling or manufacture of sale of haram products such as liquor, pork, or meat slaughtered according to Islam. They're involved in gambling, activities containing an element of gharar like conventional insurance. All this they will not look further, because the moment these are the main activities, they will just drop the whole thing. Okay, there's no more further screening. Okay, while it is easy to identify how many companies involved obviously in haram activities, the challenge lies in that we have mixed activities. Okay, so given contemporary Sharia scholars agree that such companies can be considered, but they are further filtering of that. So there are companies that have some portion of the business in forbidden activities. For example, Malaysian Airlines is normally carrying passengers and cargo, so normally that's halal. But they also serve or sell alcohol for the passengers. So the amount of profit is basically not very much. Normally would pass the screening, but because of the perception of alcohol, so image perception, so it is not listed as Sharia compliant in Malaysia. On the other hand, unfortunately, there's some inconsistency. The screening do not cover areas which I think, for example, AirAsia does not sell alcohol and their debt level is okay, so they are considered Sharia compliant. But unfortunately, we can see the stewardess uniform, which is the moment you get into a plane, it's not Sharia compliant. We're not talking about hijab. It doesn't even meet the criteria of decency. So I don't think AirAsia should be Sharia compliant unless they change the uniform, which they can do if the Sharia Advisory Council force them that, look, if you do not change the thing, we are not going to list you as Sharia compliant. Okay, so here the core activity must, okay, so here in Malaysia, the core activity cannot be forbidden, which we already discussed, okay, alcohol, etc. And then for the maslaha, because the public benefit, we allow some level of mixed activities. That's why we go for the second level, okay. So this list is the ban list, okay. So conventional banking, gambling, liquor, pork related, non-halal food beverage, tobacco, entertainment is not non-Sharia compliant, interest income earned received is too much, dividend received from non-Sharia compliant stocks, other activities deemed non-Sharia compliant, all these are out, okay. But if they are mixed, okay, if they are some elements of these things, then there is a 5% benchmark, okay. Okay, if they are directly involved, okay, if that, okay, so how they do, the first one is a business activity, the 5%, and the second one is how is the firm finance, okay. So the computation of percentage of non-permissible activities, the company's income and profit. So there are two ratios here, total income over revenue and profit before tax, and then income or earnings and profit before tax, which from non-permissible activities. So this is the ratio used, earning from non-halal activity over total earnings of firm times 100. So the percentage here, if it is indirect, if it's direct, it's part of the company, it cannot exceed more than 5%, okay? And profit before tax from non-halal activities also cannot exceed 5%. So both this ratio must be 5% or below, okay? Then 5, okay, and then, okay. So unfortunately, there is one more problem, that is, if the activity is not direct, non-compliance may be indirect. For example, let's say you have portfolio of properties, okay? You just, okay, or normally halal. But sometimes we have, let's say a mall, and there are 2-3 restaurants offering non-halal thing like pork, okay? And then in that case, the SAC uses a 20% benchmark. So if 20% of the total income from the particular portfolio is haram, then they'll still accept it. But if it's more than that, then they'll not accept it. And then finally, we have to look at the debt financing. How is the firm financed? Whether it's a debt to total assets and interest-bearing cash deposit to total assets. So these are the ratios they see. Interest-bearing debt over total assets 100 and cash earning interest over total assets to 100. So in this case, the order is not 5 or 20, is 33%. Okay. Why then is a difficult. We have to can go and argue about that, but this is what they have used. And there's also another in, okay. Since we are running out of time, I'm just saying, I'll just highlight the difference between the Jawdons and now Jawdons, they have so many thousands of companies, so they are tighter in their screening. So those who have mixed business, they don't allow at all. Only 100% halal business they allow. So the only thing they see is the debt. So all this haram business, they don't allow at all, which is, so it's more Islamic. Then they will see that the screening in Dow Jones is only the percentage of debt capital. Okay. So total interest bearing debt over 12 months. This is the amount of interest you pay. And the other one is the capitalization, that is cash. This is the balance sheet ratio. They look at the cash deposit, marketable securities, and all over the total, what you call capitalization, and also the current assets over the total capitalization. So all these things, both also 33, if more than 33%, they will say that this is not Sharia compliant. So the only thing they look for is the debt ratio and not this thing, because there is no case of non-halal earnings in the Dow Jones thing, except for the debt element. Okay, Assalamu alaikum. I think I'll stop here. Assalamu alaikum wa rahmatullah.
Yeah. Jazakallah khair, Professor. I think you covered enough in very stipulated time. First, as a student, I have to apologize that we are not giving you the required time. Bear with us. But inshallah, this is an eye-opener webinar wherein, further we can add to whatever areas of specialization, inshallah. So what we are trying to do at TAMWIL Academy is to bring in both sides on the technical part of Islamic finance, along with the Sharia part of Islamic finance. And Professor Dr. Shahul Hameed, who's joined us from Malaysia, and for those who have not known him well, he is a retired professor both from IAUM and INSIF, very reputed Islamic finance, universities by themselves, and also specializing in Islamic finance. Jazakallah khair, Dr. Shahul Hameed Sahab, again.